Stanford University.
So welcome back to the Venture Finance series in E145 Technology Entrepreneurship. In the last couple of videos, I was introducing venture fundraising for startup firms, and we spoke a bit about the multiple stages of financing, how to think about the amounts and sources of funding you need, how to think about the deal structure, and then we took a look at the impact of multiple fundraising rounds on the dilution of the entrepreneurs and the overall valuation of the company. We also introduced some financial terms such as the price to earnings ratio, the share price, and the price to sales ratio. So in this video, I want to bring it all back down to earth and give a few more practical tips on how to think about pitching VCs. And so before we do that, I want to help you understand a little bit more about the structure of a venture capital firm. And one important thing to note is that I certainly don't have in mind that all of you are going to go out and raise money from venture capital investors. The vast majority of startups aren't going to. But learning how venture capital works is a good set of tools to enable you to think more clearly about raising capital from other sources, because many of the same issues and deal structures can be involved. So the typical economics of the VC firm looks something like this. The VC firm raises a fund. That fund might last somewhere between 5 and 10 years. The partners in the VC firm get to draw what's called a management fee, typically 2 or 2.5% of the funds under management, or the assets under management. They also get a piece of the carried interest, so they have some incentive to invest in profitable companies. Carried interest denotes the profit that comes out of splitting the proceeds from selling these entrepreneurial firms or having them go through an initial public offering that flows back to both the institutional investors in the VC firm, but the partners in the firm also tend to get 20 to 25% of those profits, so the money that they generate from their investments. And so as a simple example, imagine that a VC firm raises a $100 million fund. They get a 4x return, and they get 2% of the assets under management and 20% of the carry. They would then get $2 million per year in management fees, and they would also get 20% of the profits. So if we have a $100 million fund, they get a 4x return. They have to give back the initial $100 million to the institutional investors. They get 20% then of the profits, is going to translate into $60 million in carried interest from the fund. So in addition to the $2 million per year that they get in management fees, at the end they would come away with $60 million in carried interest. And so this is essentially how venture capital partners make their money. So what does the structure of the firm look like? Your typical venture capital fund is going to vary somewhat in structure, but you would have some general partners. Each of these general partners might have between 6 and 8 active deals going at a time, so startups that they've invested in where they're on the board. They also might have some principals or associates. These principals and associates, it's their job to help with due diligence, to help drive new deal flow, that is, new startups coming in, pitching to the firm. It's their job to go out and find some of these, convince them to come in and pitch this VC firm on investing. They also might help some with portfolio company development, so assisting with the existing companies that the VC firm has invested in. There might be some staff that helps with finance, marketing, human resources. And then the decision-making process also can vary from one VC firm to the next, but typically the partners would get together and have some kind of voting process or perhaps a unanimous decision-making process. Individual partners would champion a deal that they want to invest in to the rest of the group, and the deal team, so the partner and the principals or associates who are working on this deal, would do the background due diligence and research to build the case for investing in this particular startup. And then the rest of the partnership would then act as a kind of check and balance to ensure that there's careful decision making, and that they'll then ask the tough questions of this partner and his team of associates or principals, that they've really done their homework, and that this deal is worth investing in. So one important thing to note is there are many different flavors of VCs. So VCs can segment in one of a number of different ways. So some VCs will focus on a particular sector, say healthcare, IT, clean energy. So you want to be sure that you're pitching a venture capital firm that invests in the industry sector that your startup is in. They also vary in terms of size. There are some small funds that would invest very early stage. There are also some very large funds that might tend to invest more at a later stage. So in terms of geography, VC funds tend to invest more in their geographic region. So if you're raising money in California or in Silicon Valley, you probably want to pitch funds that are in Silicon Valley. On the other hand, if you're in Boston, you might pitch VC firms that are primarily based in Boston. And so you also want to be careful that you are pitching a fund or approaching a fund that invests in the stage of your company. So if you're at the seed stage or early stage, meaning perhaps you're just a couple of people and you have a demo or a prototype or just an idea, then you want to make sure, does this VC firm actually invest at the seed stage or early stage? Because some might only invest at the later stage, and so they might be happy to talk to you and learn from you, but less willing to make an investment. So one of the difficult things about pitching a venture capital investment firm is that you have to do two things at once. One thing is to pat your head, the other is to rub your tummy. So what does this mean? Pat your head is to talk about the very first product, the very first customer need that you're going to be focusing on. So you have to show that you have some narrow focus, one particular market, one particular customer need that you can really achieve. On the other hand, you also have to paint a broader picture and show that what you're pitching is not just a single feature or a single product that would go better with a large company, but that you're really pitching something that could be an independent company that can appeal to a broad enough market and has some future beyond just this particular feature or just this first product. So what is it that VCs are looking for? This depends somewhat on the stage, but imagining that most of you are probably at the early stage, VCs are going to tend to focus very heavily on the team. And so they want a team that has domain expertise, perhaps that has some history of success and collaboration, but also that has a willingness to let the VCs help them build out the team. They're also going to be very concerned about the market. And so they want to know that this is an emerging and fast-growing market. So the market might have to be, the potential target market might have to be over a certain size, let's say $1 billion market or at least a $500 million market. And it must be a market that's growing quickly. So you'll also, by this point or shortly after this, see Henry Wong, who's one venture capitalist with Garage Ventures, talk about what he looks for in a startup. And so you'll see some of these themes echoed there. They also want to know about the business model. How is it exactly that you're going to make money? How does a dollar move from the customer's pocket into your pocket? And then finally, they're going to want to know something about the technology. What is it that you have that can form a competitive barrier over time? So here's the suggested playbook. First of all, you have to be committed. Raising venture capital is a long process. Often it can take 6 to 9 months from start to finish. It can help to hire a great lawyer. If you're in Silicon Valley, there are a lot of lawyers that work with startup firms and that have a good network with VCs and angel investors. So bringing on a lawyer early on can often help. You have to figure out what stage and what sector you're in. Identify, let's say, 4 to 5 or maybe even 8 to 10 venture capital firms that focus on this stage and this sector. You then want to think about which partner within the firm is relevant. So which specific partner or principal within the VC firm has invested in companies like yours in the past or is interested in companies like yours. You then want to get some kind of introduction to that partner. This might be through the lawyer, it might be through your university professor, it might be through another entrepreneur that this partner has invested in previously. You want to prepare a short 1 to 2 page overview, and you also want to probably prepare a short 30 to 45 minute presentation if they invite you in to pitch at the VC firm. And so it's important to keep in mind that the goal of the first meeting is to get a second meeting only. So if you meet this VC partner at a conference or some kind of event, you want to give them the short elevator pitch and get them to agree to a longer phone call or a longer meeting. Don't dive straight into the details right at the very outset. So what should you expect in this process? It's important to get the expectations right. So first of all, expect perhaps 12 to 16 week process from the first meeting to the close. It might even be longer than that. So you'll have a first meeting. The VCs, if they're still interested, will do some due diligence. They might bring up your startup at the partner meeting. If they continue to be interested, they might give you a term sheet. There would then be some negotiation over the terms in that term sheet, and then you would close. You also might think about preparing an investor package. So you might start assembling all the documents of your presentation, your financial plans, some references who can speak to you or some potential customers who are interested in buying your product. You want to assemble some materials that verifies your calculations on the size of the market. Your cap table, who is it that owns stock in the company, who owns equity so far. Any market research you've done, they might ask for. Any documentation on the product and your IP they could potentially ask for. And they could also potentially ask for some competitive analysis. How are you different from your competitors? The investors, just to get your expectations right, might ask for anywhere from 20 to 50% of the company. The valuation that they give is going to be some function of how much money you're looking to raise. The ownership that's already there, what stage you're at, what milestones you've made it through so far. And so a few key terms that are going to come along with this. I mentioned before that it's important not only to think about the percentage of equity ownership, but also to think about some of the terms that come along with that. And so this could include the number of board of directors seats, any liquidation preferences. So if there is an acquisition, then your venture capitalist investors might get a liquidation preference. They might be able to sell their stock before you as the founder or before the early employees are able to sell your stock. Particularly in the case where there's an acquisition where it's kind of a bad outcome for the startup. And particularly in those cases, VCs might exercise their liquidation preferences. There also might be terms for anti-dilution protection. So if the first stage VC wants to put in place some terms where if there's a second or third stage VC, such that their shares don't get diluted by as much. Participation in future rounds of fundraising might be a term. Pro rata rights in the case of participating in those future rounds. Other protective provisions in case things don't go well in the startup, then more control rights over decision making will tend to revert back to the VCs. And also vesting terms for both the founders and for the employees. So these are all things that there's some efforts to standardize, but are going to vary somewhat across venture capital firms. And so you can't just think that things are going to go well. You also have to pay close attention with your lawyer to some of these other terms about what happens when things start to go wrong in the startup and which aspects of control are going to revert to the VCs in that case. So here's one version of your pitch in 10 slides. I'll let you read this in the interest of time. If you had to shorten it and only do 7 slides, you might cut out the financials. Perhaps you might cut out an extended demo, so you could shorten the presentation even if you had less time. So what to consider? You want to think about whether your idea is sufficiently baked. You want to pick your co-founders very carefully, since that's going to have a lot to do with your success in fundraising. You also want to think about your fit with the venture capitalists. In accepting venture capital into your startup, you're not only getting money, you're also getting a set of partners. And so this is much like a marriage or much like a co-founder. You want to think carefully about whether your personality, values, and knowledge fit well with the venture capitalist partners you're bringing in. You want to optimize not only for the best deal and for the best price, but ideally you want partners and VCs who are going to be able to help you and give advice and connections with your venture. And you also want to consider the downstream effects of your financing. If you get a very high post-money valuation, this can become problematic later on if you run into stumbling blocks or things take longer than you thought. It's very difficult to have a down round where the next set of investors doesn't want to give you as high of a valuation as you had in the last round. That's just painful for everyone. So actually having more of a normal trajectory where you have a low post-money valuation in the beginning and gradually build it can be better from the startup's perspective even. And then you also want to be careful about angel financing. If your angel investors aren't experienced and sophisticated, they can in some cases cause problems down the line. On the other hand, angels can also provide a lot of value. So in terms of approaching VCs, you want to keep in mind that investing is definitely a people business. A lot of this is about social network connections. And so the best way to approach a VC is through some form of introduction. If you happen to know one of the entrepreneurs in their portfolio that they've invested in previously, or if you can get to know them, then an introduction through an entrepreneur that they've invested in before can be one of the best ways to get introduced. This can also be through one of your professors or through a lawyer. Usually sending a business plan in over the wire through email is not going to be a very effective way to get noticed. You're going to go straight to the bottom of the stack of business plans and startups that the VCs are looking at. So try and get an introduction through a trusted source. Some final tips. You have to learn how to hear no. Don't take rejection personally. You're going to have to go through a lot of no's before you get someone to say yes. There are many famous examples of high-profile startups in Silicon Valley where the initial VCs that they pitched turned them down. Some VCs even put together their anti-portfolios of companies that came through that they didn't invest in that they wish they had in retrospect. You're going to tend to run up against this factor that all VCs are interested and are going to want to hear from you and keep in touch. And so you have to do some reading to see just how interested they really are and whether or not they're just kind of stringing you along. Some are going to give you a very quick no. You don't want to waste your time trying to convince other partners or convince them once they've said no. Just move on to the next venture capital firm. You also don't want to ignore junior partners or associates or principals. They often have high incentives to find good deals and can be a champion for you within the firm. There are lots of VC firms out there. You want to probably order them in terms of your most preferred investors and then your least preferred investors. And you can get some practice giving your pitch and answering questions if you work from the bottom up, rather than starting with the VC firms that are most ideal for you. So that's been a bit of a look inside the VC boardroom. Let's talk quickly about how the entrepreneurs might split the pie. And so this is kind of your typical distribution of outcomes, where most firms, 67%, are only going to have a value at exit of perhaps between $0 and $1 million, and a very small number of firms are going to have exits that are at the extreme high end of $1 billion plus. And so because of this extreme skew in the distribution and the riskiness of entrepreneurial ventures, your typical VC is going to average about $5 million per VC-backed company, but they're much more well-diversified than the entrepreneurs are. The average founding team gets about $9 million per VC-backed company, but this is mostly from the small probability of a few great successes. And so your economically rational founding team might sell at VC funding for about $900,000, but as we know, entrepreneurs tend to be optimistic and tend to want to take the chance at the big outcome. I've already mentioned a few factors in obtaining VC, including your work history, your social network, the size of your founding team, and your timing. A few tactics that you might want to think about is what's called casual dating. So this is getting coffee or just kind of chatting more casually with a venture capitalist to try and get a reading of what stage and what sector they invest in, how interested they are. You should also time your fundraising around milestones or proof points. So at the stage where you've completed a milestone, this then reduces risk and creates value. You're going to get better terms. Fostering some competition is helpful. If one VC firm is interested, then you'll tend to find that others can get interested much more easily. And also scrutinizing interest. How frequently are they calling you back? Are they checking into your network for verification? Or are they just kind of wanting to stay in the loop and hear from you if something pans out? So finally, I think the most important thing to think about, besides keeping realistic expectations, is that you want to get true value added from your investors. You want people who have a Rolodex, who have a network, who have experience in your sector, in your industry, who can actually help you build the business. And so you want more from them than just money. Finally, my favorite comic about venture capital, I call my invention the wheel, but so far I've been unable to attract any venture capital. And so that's it. This has been the series on venture financing, and there's a lot more to learn in this topic, but hopefully this has at least given you an introduction to the basics and some practical advice for going out and raising money for your startups.
For more, please visit us at stanford.edu.